Hello, everyone. Today we are talking about none other than Apple. For a very long time, Apple held the title of being the largest company in the world. But in the past 5 years, things have changed a little bit, and Apple has lagged some of its peers like Nvidia and Microsoft. Now, in the second half of 2025, Apple stock has been on a tear, going up 34%. And this is mostly on the news that the new iPhone model is doing relatively well. And so the question here for many investors is this the start of a new growth cycle for Apple? Today, we'll be looking at what is going on with Apple and is this a stock that you should be considering as a holding in your portfolio? Now, this is the first video in a new series where I will be building a company database in public, a database with all the highest quality companies in the world. Each year, when the company reports its full year financial results, I'll be giving the company a quality rating, which goes from A to F. It's pretty self explanatory. The best companies in the world will be receiving a rating of A or maybe B. And the most horrible companies in the world, the ones that are more likely to destroy shareholder capital, will be rated as D or F. Now, the experiment is that regardless of the price of the company, the stock price, companies that are of higher quality should outperform those of lower quality over the long term. A's should do better than B, should do better than C, and so on. And so this chart will be tracking the performance of the quality ratings that I give out to these companies. Given a long enough time period and a large enough sample size, I do believe that A's and B's will perform the C's, D's, and F's. So far, it's still early days. The table is still looking a little bit messy. For example, F's are currently outperforming everything else, but we only have two companies that have reported. So obviously, this is not large enough of a sample. The quality rating is a proprietary system that I've designed at Rated A. And the entire point is to figure out which companies deserve higher multiples and which companies deserve lower multiples. The theory goes that if a company has a very strong moat, really good growth prospects, and a very strong risk profile, then it deserves a higher multiple than a company that has a very weak moat or no moat at all, that has declining revenues, declining free cash flows, and that is very risky. So here we go. Apple reported results a few weeks ago, so it's time to give Apple our yearly ratings update. I'm a long term value investor. What that means is I don't really care what happens to Apple on a day to day, month to month basis. I don't care if Apple misses earnings, if Apple misses revenues or expectations. What matters to me is the fundamentals. What are the things that really make Apple's business tick? For Apple in 2025, there are four major developments that I think I need to comment on. The first one is the growth of the services segment. Now, this story isn't new. This story has been the important driving force behind Apple's stock in the previous 5 years. Everybody knows that hardware is not as good of a business as software, and Apple has been trying to make that transition from hardware, iPhone, MacBook, whatnot, to software, which for Apple is services. Lo and behold, services was the segment that grew the most, the fastest in 2025, coming in at 14% growth. Surprisingly, the services segment is accelerating because the previous year it only grew at 13%. Now, I'll repeat myself. I think this is the most important metric to follow for Apple. And there's two main reasons. The first is that with these services, this is predictable revenue. It's not lumpy, it's not as cyclical as iPhone sales or MacBook sales. So for Apple, this is really high quality revenue growth. And it shows in the margin. Just look from 2020 to 2025 how fast and how predictably the margin is ticking up year after year. Because yes, software is more profitable than hardware. You don't have to buy products, you don't have to run factories and so forth. You don't have to import, export, and move merchandise from one country to another. And for those who don't know, when I say services, what it means is Apple Music, Apple News Plus, Apple TV, and all those little extras that you can get when you're within the Apple ecosystem. Because here's the thing, Apple's services is probably the most important thing to lock customers into that ecosystem. Once you have your photos on Apple, once you have your music on Apple, once you read your news on Apple, all of these are extra points that keep you hooked into that ecosystem. So the more these services grow for Apple, the stronger the moat gets. But that's not the only thing, because when Apple makes more money with services, Apple gets larger and has more money to play around with and invest. And that manifested itself in 2026 with a new broadcast deal for Formula One in the United States. If you live in the United States and you want to watch Formula One, your only option is to see it on Apple. So, once again, this plays into the switching costs and the ecosystem moat. It also plays into the scale moat because, yes, Apple is one of the largest companies in the world. Apple generates the most cash in the world. And so Apple can make investments such as these to improve its ecosystem. Don't be surprised if in future years Apple starts to broadcast different sports as well. The second important development for Apple in 2025 is that it's moving some of its supply chain from China to India. Now, I don't need to tell you that this is really good for diversification. If anything happens to China, whether that's tariffs from the Trump administration, or if it's an earthquake or anything like that, Apple is now diversified, and that's good for the business and the risk profile. It's also good for future growth because Apple will now have exposure to the population of one of the fastest growing countries in the world, which is India. But there is a little caveat to all this. The first is that China is just decreasing in importance when it comes to Apple's business. You can see this as a pro, and you can see this as a bad thing. The pro is that as sales decrease in China, well, China, which is a pretty volatile region, gets less important for the business. But at the end of the day, this still used to be one of the most important regions for Apple. And every year it is just losing market share, losing revenue in this region of the world. Down 8% in 2024, down 4% in 2025. This could be due to many things. Most likely, it's competition and it's young Chinese generations preferring national champions like Oppo or like Huawei to just Apple. The other thing that's really important for Apple's risk profile is that it's still highly dependent on Taiwan, this little region of the world. Because TSMC makes all of Apple's chips, all of its important chips that go into Macs and iPhones, if anything happens to this really volatile region, if China decides to invade, for example, in future years, that could have really big consequences for Apple. So even if the supply chain moves from China to India, the importance of Taiwan is still there. The third very important development for Apple, which is not really a development because it started in 2024, is that the DOJ is still coming for Apple. Now, this remains a really big overhang on the stock just because it's something that could potentially have a really big impact on Apple's moat. Now, just as a reminder, what is the DOJ alleging? They are saying that Apple is abusing its monopoly power by doing very small things. For example, the green bubble versus blue bubble. If you text another Apple user, they will receive your message in the blue bubble. If it's an Android user, it'll be green. Another one is the restriction on super apps like Tencent's WeChat. These super apps are quite dangerous for Apple's moat because they explode the ecosystem. All of a sudden, Apple's iPhone is not the center of that ecosystem anymore, it becomes the app. If the ruling from the DOJ is really negative, it could have a really big impact on Apple's moat and therefore its future profits, and the stock price could really take a hit. Thing is, this ruling is not expected to come anytime soon. I don't think it'll come in 2026. So this will remain an overhang on the stock for a long time. The fourth and final important development for Apple is that it's still innovating. People say that Apple is stagnating, the revenue hasn't grown all that much in the previous 3, 4, 5 years. But in 2026, that could start to change. First is that there are early signs that the new model of iPhone is selling really well. So that could be a positive cycle for Apple, and we could see a new wave of increased revenues in 2026 and 2027. But behind the scenes, Apple is doing something really interesting. They're investing in health technology, and you can see it with the changes they're making to the Apple Watch. Yes, it can count your steps and tell you how well you slept. These are not new things. But Apple is increasing those capabilities, and now the watch can track your blood pressure, your blood sugar levels, and it can even know whether you have a fall or something like that. That's really important for old people, for example, old people that live alone. The other thing is the Vision Pro. So far, people say that it's been a fail, and yeah, it's really expensive. It hasn't sold all that well. I don't think that was the point, though. The point is to get developers to start developing apps on the Vision Pro and to start iterating. Now, Apple has realized that maybe this big, clunky set is not something that people will be wearing in public. And it seems that they're moving more towards the Meta model, the one Zuckerberg has developed, the Ray-Ban glasses, something that's lighter, that's cooler to wear in public, and that's augmented by AI, obviously. So this is also something to watch out for. The competition between Apple and Meta is only expected to heat up in the future years. So despite these four developments, nothing much has changed with the overall fundamental story of Apple, and that's reflected in the quality rating. All the score components have been maintained, so Apple is still an A for 2026. At the end of the day, this is still a really high quality company, the revenue ticking up year after year, the margins increasing over time, research and development budget going up over time. This is really important for Apple to stay ahead of competitors. Return on invested capital above 30%. This is huge. The company's still buying back shares. I'm a little bit more iffy on this one because I think Apple stock is quite expensive. The balance sheet looks great. The free cash flow per share is going up and to the right over time. So, yeah, I'll repeat myself again. This is a company that is worth owning in any portfolio. That being said, the price to free cash flow multiple is currently at 46, and that is reflected in the value rating, which indicates when a company is a good buy opportunity or a sell opportunity. At the moment, Apple is way closer to that sell than to the buy. Let me show you. If I do a quick calculation for the valuation based on today's price, I assume 5% revenue growth over the next 5 years. I was really generous with the free cash flow margin. I put 27%. This is more than they've done in the last 5 years. I assume they'll keep buying back some shares. I put a terminal multiple of 30, which is really generous for a company that's not growing all that fast. At the end, we get a compound annual growth rate of 4.9% for the next 5 years. This is way below the average of what the S&P 500 does, and I don't think Apple is a good buy at these levels. So it is what it is. While it would be nice to own Apple one day, you have to wait for it to happen at the right price. Otherwise, your returns will really suffer. So that's it for this video. Let me know in the comments below if you own Apple in your portfolio. What do you think about this company? Are there any catalysts in 2026? Are you expecting anything in 2026 that will really give the stock price a new boost or that will explain this really high valuation? Also, if you like this new format, this new type of video where I cover the updates in the database, let me know in the comments below. That's it for this one, and I'll see you in the next video.